What are the mechanics of a butterfly option spread? All butterfly strategies consist of one lower or higher option strike, two middle option strikes, and one higher or lower option strike, depending on if you are trading puts or calls. All the options share the same expiration date. Okay, they all share the same expiration date. Most traditional butterfly strategies are all puts or calls and have the same distance between each strike. Okay, the traditional ones have the same distance between each strike. You do have some that are non-traditional that we're going to discuss in a bit as well. Also, most traditional butterfly strategies are direction neutral. Okay, they don't have a bias on which direction you actually. The traditional ones are wanting the market to stay in a very, very tight range. All right, so let's look at what the setup of that is. So, for example, if you're going to buy one, it's similar. It looks similar to this here. You're buying that, and let's say you're selling 3 points lower here, or 2 points lower here, and this is what is called a put spread initially. Okay, this is a put spread here. That's how it's set up initially, and then you buy one 2 strikes below. The traditional, once again, is the strikes, the distance between the strikes are the same. All right, so this is all 2 point wide spreads. And it looks like this, but the middle strike is the one that you add 2 to. All right, so when you're looking at this here, this right here is saying 2. This has 2 short legs there. Okay, you have one here and one here. And this is a traditional type of butterfly, right? Usually around at the money, and the strikes are the same distance between each other. This is how a butterfly looks. And so let's move on and jump into it a little deeper here. What is a long butterfly call or put? So the long call or put butterfly is when you, 1, buy an option nearest to at the money. 2, you sell 2 middle options, and 3, you buy an option furthest from at the money, right? Your maxed risk is what you pay for the option, and your max profit is the underlining, if the underlining is at the middle strike price at expiration, right? This is a net debit strategy. This is money's coming out of your account. This is buying. If you are buying a put butterfly, you want the underlining to go down, but no more than your middle strike price. And if you are buying a call butterfly, you want the underlining to go up, but no more than your middle strike price. All right, so let's break that down a little bit here. Back over here. All right, so one of the worst type of things you can do, and it's not, most people don't do this, is you actually are the seller of the option. And we'll show that in a bit here, but let's act like we're buying this put here. We're buying that one in the money, selling this one, and we're buying this one. So this is a 2 point wide again, the same kind of example I just showed. We're going to add this here. And so it's 2 in this middle again, and it's 2 there. All right. So when you're doing this type of strategy, it's a very low probability type of strategy because you are in the money already, and you need it for max profit on this. You need it to go here. Okay. And your max profit is basically $200 minus what you paid. Okay. So in this case, when you're buying this, butterflies are usually pretty cheap. So you're paying 9 cents before commissions and fees. Okay, paying 9 cents before commissions and fees, or $9. All right, and you want it, once again, to go. You want it to stay here, but what's the probabilities of that happening? Right, we looked at this probability, and this expected move is plus or minus 14. Right, so it's a low probability trade, but you're not paying that much out to do it. And if it goes, if it falls, at the 326, you're going to make a little money. And if it stays around the 325, you're going to make some money. But obviously, if it goes past that, you're going to start you're going to start losing, and what you can lose is only what you paid for, right? So your max loss is that $9 that you paid. So it's not a big deal, but it's not that attractive a strategy to me, right? I'm going to show you something a little later that's a lot more attractive, but this is just, you're expecting it to stay in a tight range. And obviously the market here is not expecting it to stay in a tight range. All right. So if we were doing the call side, right, let's just say you were buying the call side. So you would buy, let's say, one in the money, and you would sell one out of the money, and buy one out of the money. And once again, this is going to be the 2 here. This is the 2. This is just doing it on the call side, the same kind of concept, but just doing it on the call side. And your probabilities are very similar, not very high. You're expecting it to stay. Your max profit is right here if it lands in that middle, and the probabilities of that are not very high. But you can make some money if it stays between there as well a little bit. But this is, to me, this is not that attractive strategy to try to make money, but it's a decent strategy to hedge. Okay, so because you can potentially, it's not even that great of a hedge either, based on what we're looking at here. But if it fits in if it fits in that middle area, then that how much it could hedge you for. But I'm going to show you something a lot better in a second here. What is a short call butterfly? All right, so a short call butterfly is when you, 1, sell a call option nearest to at the money. 2, you buy 2 middle call options. And 3, you sell 1 call option furthest from at the money with the same distance between the strikes. This is a net credit strategy. This is money's coming into your account. Okay, your max loss is the difference between the nearest to at the money short call strike and the middle call strike minus the credit you receive. A short call butterfly is a direction neutral strategy for the most part, but you do prefer the underlining to go down. However, if it goes up, you don't want it to go past your short nearest to at the money strike. All right, so let's just say you were selling this one, right? And you were buying this one, and you were selling this one. So it's the same kind of concept we were just looking at a second ago, but you're going to double this one up, right? But instead of buying closer to at the money, you're selling closer to at the money. So in this case, you're going to receive a credit of $9. All right, but this is a horrible type of trade because the most you can make when you're the seller is how much you receive. Right, so the max profit on this is $9. So you will hardly, no one would ever put this trade on. It makes no sense, right? Because you only receive $9, and after commissions and fees, that is even lower. For example, if we look at this, even on the TastyWorks platform with good commissions and so forth, this is only less than $5. So why would you do this trade? You wouldn't buy and you wouldn't sell this, right? And then if we flip this over, and we'll show that in a second, right? So what is a short put butterfly? If the short butterfly is when you sell a put option nearest at the money, and you buy 2 middle put options, and you sell 1 put option furthest from at the money with the same distance between the strikes. Once again, it's a net credit strategy, and your max loss is the difference between the nearest to at the money short put strike and the middle put strike minus the credit you receive. A short put butterfly is a directional neutral strategy for the most part, but you do prefer the underlining to go up. However, if it goes down, you don't want it to go past your short strike nearest to at the money. So if we go back over here, this is the same kind of thing that we were talking about. Let's just say we sell this and we buy this and sell this, and we're going to make this 2 again, and this is, once again, this is 2, and you're selling this, and the max you receive on this right now is, see here, max you receive on this is $7. So that's even worse than what we were doing on that call side. And you wanted to stay, obviously, pretty much no you don't want it to go below this 326. And so this is a horrible type of trade as well on both sides. It's just not, it's just not worth selling, right? And then you can argue that it's not worth buying as well, right? So, but it's always trade-offs, and it's always ways to position a trade a little better. All right, so what is the best way to make money trading butterfly spread? All right, so at the Dorian Way, we believe the best way to make money with a butterfly spread is to use the broken wing butterfly strategy. All right, so what we've been talking about to this point are traditional butterfly strategies. Okay, and you can make those whiffs, the distance between those whiffs, a lot more, and it can make it a little better for you. So, for example, if I was going to buy something, I can buy it. Let's just say I bought it here at the 25 the 325, and then I decide I'm going to sell 2 wings there, and then I'm going to buy another 5 points down. All right, so this is the width of the spread. The distance between the strikes are wider than the 2 that we were looking at before. Now they're 5, right? And we turn that to 2. And so now you're dishing out, right? Now this to me is this is better, right? Traditional way. You're dishing out 36. Your potential max profit is this 464, right? And your max loss is obviously what you pay. That's the $36. And if you're doing this, you can make money as long as it stays below that 325 and in here. This is where you have your max profit at. Okay, this is where you have your max profit at, where it stays there. So it's still a lower probability trade, but it's better than what we just looked at with just a 2-point wide. And then obviously a 1-point wide is even worse if you're doing in this SPY. But when you're doing a broken wing butterfly, for example, you buy one put option nearest to at the money, and you sell 2 middle options, 2 strikes lower, right? The 2 middle strikes are sold a little lower, and you buy one put option 10 points lower than the middle strike options for net credit. So we were talking about earlier that if you are selling something out of the money, your probabilities change dramatically, and they can be pretty high. So in this case, let's look at this. Let's hit clear here, and let's act like we're buying the 33 delta here. So when you buy, you click on the ask, and then let's sell this 30 delta, so 2 points lower. Okay, and then let's buy 10 points lower. So from the 316 to the 306. Right. So when you're buying, once again, you click on the ask, and this is what is called a broken wing butterfly. Right. A traditional butterfly, the distances are the same. This distance has changed dramatically from this short strike to this long strike here. All right. So let's change that to 2 here, and let's look at the mechanics here. All right. So you receive a credit. This is a credit. This right here, it says credit, and this is a credit. You receive a credit of 125. Okay. So regardless of if the market just sits right where it's at, you're going to still make $125 before fees and commissions. All right. So, and if it goes and it stops around right here, okay, you're going to make your max profit of 325. Okay. And we were talking about probabilities before. Your short strikes are here at the 30 delta. Okay. Your short strikes are here at the 30 delta. So in this case, you have a 70% chance of winning on this trade. At least a 70% chance of winning on this trade. And this is a butterfly, a broken wing butterfly, right? So that when you're doing something, you want to have at least a 50% chance of doing something, of winning. When you're trading traditional butterflies that we just went over, that's usually about a 30% chance of winning on it, right? So very small at the best, right? A lot of times it's 8%, 7, 10%, things like that. Well, in this case, this broken wing butterfly is at least 70% probability of making at least 1 cent at expiration. All right, so if we are looking at this and we say, okay, well, what if we bring that in a little, right? So you can decide, well, instead of 10 points, maybe I'll make this 5 points, right? So we'll go to the 311 here. So still a broken wing butterfly, right? So instead of receiving 125, you're going to receive 51, a credit, right? But your potential max loss is different, right? It's less, right? Your potential max loss here. So when you're thinking about probabilities, if you have a high probability of winning, then your possible loss is usually with options is going to be bigger. The higher your probability, the bigger your potential loss might be, right? But your probabilities on your side, just like an insurance company, right? If you have a $15,000 car and you're not going to pay the insurance company $15,000 to insure you, right? You're going to pay them a fraction, and they're taking on that other risk. But they understand the probabilities on their side, so they will charge you, let's say, $1,000 for a $15,000 car. If you get in a car wreck that's completely totaled, then obviously they're out of $14,000. But they understand the probabilities that that's a small, chance, so they do that. So in this case, you don't have your max loss can be 249, but your probability of success is at least 70%. All right. So, and this right here is, this is a pretty good trade credit wise, right? And if you decided to use a broken wing butterfly for a hedge, so let's just see if let's discuss it regarding a hedge. Let's just say you wanted to buy at the 30 delta. You sell, let's see, let's just make it 4 here. You sell here, and this is going to be 2, and then I just buy here. So this is telling me that this is a net debit, right? I'm paying 45 cents for it, but this is going to hedge me up to 355. Okay. And so if it goes, this is one of the key things about why the Dorian Way will use this as a hedge, is that if it goes past this area here, you're going to have your max hedge around this middle strike that we've been talking about, right? You're going to have your max hedge there. But if it shoots past this and it continues to go down, you're still going to make some money, because this short leg here, this embedded short leg, it looks like this. You have an embedded short leg that looks like this. Okay. Looks like that. Your max loss between these two points here, if this was just one contract, let me change that to 1. All right. So your max loss between these two is 200 minus the credit you receive. This is the credit you receive, and this is the max loss, right? So you have to look at it. You have to kind of break these butterfly down as 2 different trades, right? So if we go back to put the other part of the butterfly back on, and let's put this here, we can, if it goes down, make our max profit here as that 355 before commissions. And then if it goes down here, we're going to lose a little bit, 200, but we can still make 155. Okay, even if it goes past that, this could still hedge us $155. Okay, all right. So this is the broken wing. You can kind of play with these all different type of ways and adjust it. And this is one of the great things about the TastyWorks platform, is how you can move things. You can move things pretty, just like I said, like using a phone, which is awesome. All right, so some negative things about the TastyWorks platform, but I'm sure they're going to get it all squared away in the near future. All right, so let's jump back over to the slide and let's talk about the broken wing butterfly is something that is a higher probability. You can receive a credit, and you can make more than your credit if it goes in the direction that you want it to go. All right, so but obviously, if you don't want it to go too much, if you didn't offset your risk.